So now we're going to move on to net profit. This is sometimes referred to as the bottom line. It is the amount of money that the business is left with after they subtract their total business expenses from their total revenue, as you can see from the formula that's on your screen now. However, a business's net profit doesn't include any tax payments, as the tax a business pays is actually based on their net profit figure. Therefore, you may also see this called net profit before tax. The net profit figure appears at the bottom of the statement of financial position. Therefore, the total business expenses include the cost of sales figure used in the gross profit calculation, but also includes all other costs such as the operating expenses and all other overheads that are incurred by the business, such as rent and interest on loans. Therefore, the net profit will always be lower than the gross profit. The higher the net profit margin, the better it is for the business, as this shows how profitable the business is overall, a key measure for any business and something that stakeholders would be interested in. So let's take a look at calculating the net profit. Same as the gross profit, the figures a business requires to calculate their net profit can all be found on their income statement. Firstly, we start with the sales revenue, which in this example is £250,000. We then deduct the total business expenses, which in this example is £220,000. This leaves us with £30,000. This is our net profit. Once a business has calculated its net profit, it can now work out its net profit margin, which is shown as a percentage, in the same way that the gross profit margin is shown as a percentage. The net profit margin is calculated by dividing the net profit of the business by their sales revenue, and then multiplying the answer by 100, as shown by the formula on your screen right now. So if we use the figures taken from the previous example, this would require us to start with a net profit of £30,000. We would then divide this by the sales revenue, which is £250,000, and this would give us an answer of 0.12. Now it's very important to remember to multiply the answer by 100, which in this example gives us 12. This is your net profit margin. Remember, it's shown as a percentage, so it's 12%. Just like gross profit, to interpret the net profit, a business will typically do one of two things. They can compare their net profit to their competitors, or compare their net profit against their previous year's performance. By improving the gross profit figure, the net profit figure will naturally increase. And a key point to acknowledge is that the net profit will always be lower than the gross profit. This is because it is at the bottom of the business's income statement and therefore has to also deduct the operating costs and overheads from their sales revenue. However, in this example, our net profit is much lower than our gross profit. The gross profit for the business was £150,000, giving us a gross profit margin of 60%. However, the net profit was only £30,000, which gave us just a 12% net profit margin, meaning for every £1 of income, only 12p is net profit. Therefore, it is clear to see in this example that the business needs to reduce its operating costs and overheads. So the owners and management team should investigate costs such as rent, insurance and salaries to see if there is any opportunity to reduce these costs further. And if they were successful in doing this, this would ultimately increase the business's net profit.